Hi there, my name is Bill Starnes, Senior Advisor at Mallard Advisors in Hockessin, Delaware. I'm here to talk today a little bit about income taxation. It is that time of year, and I'd like to explain the basics of our income tax system. And first, when talking about income taxes, at the most basic level, we have to understand that there are two general types of income subjected to different tax schedules. There is ordinary income, such as earnings, and capital gain income. And for the purposes of this video, I'm going to focus on ordinary income. Now, ordinary income is subjected to one tax rate system, while capital gains are subjected to an entirely different and generally lower tax rate schedules. So, how does this income get taxed? In other words, how do we arrive at what's known as taxable income? Let me answer that by taking a look at this example of a wage earner who earns $167,000. Now, wage income is not your taxable income. There are a series of adjustments that we have to make to arrive at taxable income. For example, while this couple has $167,000 of wages, they defer over $18,000 into their 401k, and this lowers their income. Now, they also have about $5,000 of interest income, which increases their taxable income. Therefore, between their net wages and interest income, they have adjusted gross income of $153,000. It's been adjusted for these above-the-line deductions. Next, adjusted gross income is reduced for deductions and personal exemptions. Itemized deductions are things that our elected officials have determined are important to incentivizing certain behaviors. For example, this client has itemized deductions of about $20,000, which includes things like mortgage interest and charitable contributions. So these expenses reduce income. And then there are also personal exemptions that if your income is not too high, each individual in your household gets about $4,000 for a personal exemption. So this particular client, they have 4 personal exemptions. They are married and have 2 children. So they get to reduce their income by $16,200. Therefore, this brings this client's total taxable ordinary income to $118,000. Now, this is the number that gets taxed, and this tax amounts to $21,000. Well, let's see how we actually got to that $21,000 by visualizing this in a bit of a deeper way. So what we're looking at here is this left bar represents the ordinary taxable income of the client we were just looking at. And so they have $118,000 of ordinary taxable income. The middle bar shows all of the income tax brackets, starting at the 10, 15, 25, 28, 33, 35, and 39.6% bracket. So we can easily see that this client is in the middle of the 25% ordinary income tax bracket. Now, the far right column shows the capital gains brackets, but we're not going to focus on that today. And these dotted lines, they're just showing me the income cutoffs for the end of the 15% tax bracket and the beginning of the 39.6% tax bracket. So this $118,000 of taxable ordinary income gets subjected to these ordinary income tax rates, which start here. And what this shows is the first $18,550 of ordinary income gets taxed at the 10% rate. The next $56,750 of income gets taxed at 15%. Then the next amount gets taxed at 25%. So if we take a look at the math, we see here that first 18,000 is taxed at 10%, which is a tax of $1,855. The next 56,000 of this client's income is taxed at 15, and so they pay $8,513 on that chunk of income. Their remaining chunk of income, which keeps them in the middle of the 25% tax rate, they pay $10,681 on that chunk of income. And if you add those three things up, the total tax liability for this client is $21,000. And that's exactly what we just saw on the pro forma tax return, which, as a reminder, is right there. So what's important to understand is that our tax system is progressive. This means as you earn more income, you pay a higher rate of tax on that higher income. For example, if our client here earned an additional dollar of income, that dollar would be added here, and it would be subjected to the 25% tax rate. So each additional dollar they earn is subject to the 25% tax rate until their income rises up into the next tax bracket. So this is what's known as the marginal tax bracket. In other words, some people think that if they're in the 25% tax bracket, all of their income is subjected to 25% tax rate. And that is obviously not true, as I've proven here today. So it really is just that simple. Well, at least in this simple example it is. So I've focused just on ordinary income. We've only looked at a client who has ordinary income. There are other taxes out there, many other taxes in fact. But in the case of the federal income tax system, there are also capital gains taxes, and there are other taxes such as the alternative minimum tax, the Medicare net investment income tax, the additional 0.9% Medicare tax on earned income, and also self-employment tax. So for example, if this client earned this ordinary income as a self-employed individual, we would then see that there is an additional tax, self-employment tax, and therefore their total tax goes from $24,900 up to $44,349. Or if, let's say, they earned an additional $150,000 of ordinary income, we can take a look at that, and we can see that not only is there more income, but now they're also subjected to the alternative minimum tax and also subjected to these other taxes. So while in general, ordinary income, the taxation of it is rather straightforward, there are many other taxes that start to get involved as income rises, particularly over the $250,000 mark. Now let's say that this client sells a capital asset, like a stock, and realizes $20,000 of capital gains. We should also see that appear here. So there it is, $20,000 of capital gain income, taxed at the 15% tax rate, and that also gets added in. Now, what is really important to know is that we do have control over our taxable income via a variety of tax planning techniques, and we should try to control our taxable income to either take advantage of low rates while we're in them, if it's temporary especially, or to avoid higher tax rates. For example, this client who has $86,000 of taxable income is peaking up into the 25% tax bracket. But let's say they're able to participate in their company's deferred compensation plan. Then what we can see is, boom, they just almost dropped out of the 25% tax bracket. Or perhaps we have a retired client with $57,000 of taxable income who knows that they will be in higher tax rates in the future. So they may want to fill up the rest of this 15% tax bracket. So they may decide to create some income there by cashing in some savings bonds or performing a Roth conversion. But taxable income is controllable. So as you can see with a very simple example, our tax system is relatively simple. Unfortunately, it gets very complex very quickly, but I hope now this has helped you understand the basics of our income tax system. Thanks for listening.